Today, we're re-tackling a topic that a lot of people think is impossible: buying a house with bad credit. If you've been told no by lenders or feel like your credit score is a permanent roadblock to homeownership, I want you to stick around. Because today, I'm going to show you that not only is it possible, but I'll give you the exact steps you need to take to make your dream of owning a home a reality. Let's get started. First things first, let's define what bad credit even means to a mortgage lender. Generally, a FICO score below 620 is considered subprime, and anything below 580 is often seen as poor. But here's the good news: that number doesn't tell the whole story. And there are specific loan programs designed for people just like you. It's not an automatic disqualification. Lenders look at your entire financial picture, so let's work on making that picture as attractive as possible. The absolute first step is to know exactly where you stand. You need to pull your credit reports from all three major bureaus: Equifax, Experian, and TransUnion. You can do this for free once a year at annualcreditreport.com. Don't just look at the score. Dive into the details. Are there errors? A surprising number of credit reports have mistakes, like accounts that aren't yours or late payments that were actually on time. Disputing these errors is your first line of attack and can sometimes give your score a quick and significant boost. Once you've cleaned up any errors, it's time to work on actively improving your score. The two biggest factors in your credit score are your payment history and your credit utilization. So, number 1. Pay every single bill on time from this moment forward. Even one late payment can set you back. Set up automatic payments if you have to. Number 2. Attack your credit card debt. Your credit utilization ratio is how much you owe compared to your total credit limit. If you have a card with a $10,000 limit and a $5,000 balance, your utilization is 50%. You want to get that number below 30%, and ideally below 10%. Pay down those balances as aggressively as you can, starting with the highest interest cards first. Now, let's talk about the money side of things. Lenders want to see stability. This means having a steady income and a history of employment, preferably at the same job or in the same industry for at least 2 years. If you're a freelancer or have variable income, don't worry. You'll just need to provide more documentation, like 2 years of tax returns and profit and loss statements, to prove your income is consistent. Saving for a down payment is also crucial. While the idea of a 20% down payment is great, it's not always required, especially with certain loan programs we'll discuss in a minute. However, the more you can put down, the better. A larger down payment reduces the lender's risk, which makes them more likely to approve you, even with a lower credit score. It also shows them you're financially disciplined. Start saving now. Create a budget, cut unnecessary expenses, and maybe even look for a side hustle to accelerate your savings. Every dollar counts. Okay, so you're working on your credit, you've got a stable income, and you're saving money. What's next? It's time to explore loan options, specifically designed for buyers with less than perfect credit. The most popular one is the FHA loan. FHA loans are insured by the Federal Housing Administration, which makes lenders more willing to offer them to riskier borrowers. With an FHA loan, you can potentially get approved with a credit score as low as 580 with just a 3.5% down payment. View score is between 500 and 579. You might still qualify, but you'll likely need to put down 10%. FHA loans are a game changer for so many people. Another great option to look into is a VA loan. If you are a veteran, an active duty service member, or an eligible surviving spouse, you need to look into this. VA loans are incredible. They often require no down payment and no private mortgage insurance, and their credit requirements are generally more flexible than conventional loans. Lenders will look at your overall financial profile rather than just a 3-digit score. Then there are USDA loans. If you're open to living in a designated rural or suburban area, a USDA loan is fantastic. Like VA loans, they often require no down payment. They are designed to promote homeownership in less populated areas, and they have flexible credit guidelines. You can check the USDA's property eligibility map online to see if the areas you're interested in qualify. Many areas just outside major cities are eligible, so don't assume it's only for farming communities. Now, a word on conventional loans. You might think these are out of reach, but some conventional loan programs allow for a down payment as low as 3%. While they typically require a higher credit score, usually 620 or above, don't rule them out completely. As you work on improving your credit, you might find yourself qualifying for one sooner than you think. One of the most important steps in this process is getting pre-approved for a mortgage. This is different from pre-qualification. Pre-approval means a lender has thoroughly reviewed your financial documents, your income, your debt, your credit history, and has agreed to lend you a specific amount of money. A pre-approval letter is powerful. It shows real estate agents and sellers that you are a serious, qualified buyer. When you're competing with other offers, having that letter can make all the difference. To get pre-approved, you'll need to shop around for the right lender. Don't just go to the big national bank on the corner. Look for mortgage brokers and lenders who specialize in working with buyers who have credit challenges. They are more familiar with FHA, and other programs and often have more flexibility. They understand the nuances and can help you navigate the process. Be upfront and honest with them about your situation. A good lender will work with you as a partner, offering advice on how to strengthen your application. Let's talk about something called compensating factors. These are positive elements in your financial profile that can help offset a low credit score. Lenders look for these to feel more comfortable approving your loan. What are they? Things like a large down payment, a high savings reserve, meaning you have enough money in the bank to cover several months of mortgage payments, low debt-to-income ratio, and a long, stable job history. If you have a low credit score but can show strength in these other areas, your chances of approval go way up. So, if you can't fix your credit score overnight, focus on what you can control, like saving more money. Once you're pre-approved and you start looking at houses, be realistic. Stick to a budget that you are comfortable with, not just the maximum amount the lender approved you for. Remember to factor in all the costs of homeownership, like property taxes, homeowners insurance, maintenance, and potential HOA fees. You don't want to be house poor, where all your money goes into your house, leaving nothing for savings, emergencies, or just living your life. Fine. A quick note on rebuilding your credit for the long term. Once you secure your mortgage, it's crucial to continue practicing good financial habits. Making your mortgage payments on time every single time will do wonders for your credit score. Over time, as your score improves, you may even have the opportunity to refinance your mortgage to a lower interest rate, which could save you thousands of dollars over the life of the loan. I know this is a lot of information, but I want you to feel empowered, not overwhelmed. Buying a house with bad credit is a marathon, not a sprint. It requires patience, discipline, and a solid strategy. But it is absolutely achievable. Don't let past financial mistakes define your future. Start today by pulling your credit report, creating a budget, and exploring your loan options. I hope this guide has given you a clear roadmap and a dose of confidence. If you found this helpful, please give this video a thumbs up and consider subscribing for more content on personal finance and real estate. If you have any questions or want to share your own journey, drop a comment below. I love hearing from you all. We'll see you in the next video.